Welcome to Leading Professionals. If you're a professional in a leadership role, or if you simply want to understand your work and your organisation better, then you've come to the right place. In this series, I explore the complicated, messy, and surprisingly emotional challenges of leading professionals, and I set out to answer some of the most crucial leadership questions that professionals are currently facing. Today, I'm exploring two interrelated and potentially seismic changes currently rolling out across the professions. I'm talking, of course, about the impact of Gen AI and private equity ownership. To help me explore these themes, I'm joined by Michael Izza, who was longtime CEO of the ICAEW. This is a professional institution that promotes, develops and supports chartered accountants and accounting students and has over 200,000 members in almost 150 countries. So Michael has a distinctive long-term and global perspective on the accounting sector, which typically leads change across the professions. I've asked him to help me explore what's already happening and what changes lie ahead. So I started my career in the 1980s as an investment banker on the eve of deregulation, the so-called Big Bang. The old City of London was still very visible, and on the streets of the Square Mile, soot-stained Victorian offices still housed venerable financial institutions. And the government brokers still wore their silk top hats on the floor of the stock exchange. But glass-fronted skyscrapers were starting to dominate the skyline, and women like me, in power suits and stilettos, were starting to pound the streets of the city. Big new investment banks were being created from mergers between traditional British merchant banks and long-established stockbroking and stock-jobbing partnerships. I began my training at one of these investment banks, seated at a dealing desk on a big high-tech trading floor. Either side of me were partners, or rather ex-partners, who'd recently made millions when their firm was acquired, and they were suddenly very wealthy. But they seemed bewildered and bereft, forced to sit at their fancy new trading desks for the duration of their 3-year earnout until they could leave to get on with their lives. I didn't understand what they were mourning, this thing called partnership, but I understood that it meant something very special to them. Meanwhile, the market was booming, I was young, and life seemed exciting. But a year later, the market crashed catastrophically, and within weeks, the fancy new trading floor fell silent as market liquidity dried up and swathes of redundancies began to sweep through the city. During the difficult years that followed, many of the old city financial institutions simply faded away or were absorbed into the newly emboldened US investment banks. The City of London was changed forever. Now, the accelerating adoption of Gen AI, combined with the influx of private equity capital in the professional services sector, looks set to be another Big Bang moment. In the past 4 years, 1 in 3 of the top 30 US accounting firms have sold to a financial buyer, and some are moving ahead with plans for IPOs. As always, the legal sector lags the accounting sector, but the direction of travel is clear. I'm extraordinarily impressed and intrigued by the fact that you've managed to remain CEO of the ICAEW for almost 20 years. That's a remarkable tenure in any kind of role. So during that time, what's been the most significant change that you've experienced within the accounting sector?
In the past 20 years, I think we've seen nothing short of almost a revolution in audit and audit quality. Remember, when I was taking over as chief executive in 2006, we were just in the immediate aftermath of the Enron and WorldCom failures in the United States. We moved very quickly into the financial crisis, and then we had a whole series of corporate failures in the last decade. And I think that today, audit quality is probably better than it's been almost ever. That is a real shift in the period. I think the other thing is what's happened to tax in the last 20 years, because I think it's fair to say that at the turn of the century, there were quite a number of practices who probably thought that tax planning and legislation which wasn't written as tightly as it could have been, gave them license to drive a coach and horses through the legislation. And they came up with very clever tax opportunities.
You're trying to avoid saying dodges, Michael.
Yes, I am. But this all came to a head in about 2011, 2012, when you may remember there was a British comedian called Jimmy Carr who was hung out to dry by the Times newspaper. And that began to create a real momentum together with things like our corporates paying the right amount of tax. And there was a big Robin Hood tax movement. Well, one of the things that I'm proud the ICAEW were leading on was actually something called PCRT, an acronym that won't mean very much to perhaps many of your listeners, but it's the professional conduct in relation to tax. And it reminded chartered accountants what their obligations were in terms of how they conducted themselves in their professional behaviour. But it added a number of interesting additions, one of which was you should not be advising your clients to enter into any schemes or arrangements that went against the intention of Parliament, nor should you work to develop schemes which are either highly artificial or highly contrived. And I think that was a real sea change moment for many tax professionals. Now, it sticks in my mind, Laura, because that episode is the single biggest thing that generated hate mail for me as chief executive. I mean, hundreds and hundreds of very direct emails and other communications that said, I've gone over to the dark side.
Well, I think you've answered the second question that I wanted to ask you, which was, you've talked about the biggest change, but I also wanted to go on to ask you, what was the biggest challenge? I mean, was receiving hate mail under those circumstances the darkest time for you, or was that just something you let roll over you?
It wasn't really a dark time. I mean, I just took it on the chin, and in an organisation where the membership is 170,000, as it was when I left, you're bound to get some people who don't agree with your actions. So it wasn't particularly pleasant, but it didn't knock me off my stride.
This idea of running a member organisation with 170,000 members for almost 20 years, you, shall we say, survived working with probably almost 20 presidents, because their new one is elected each year. What was the secret of your longevity? There must have been people who wanted you gone. How did you manage to ride the waves for 20 years?
What I had done, and I don't think that the ICAEW was unique in this, it recognised that model of a president coming in every year and wanting to leave their mark on the organisation and perhaps have a tweak, if not a change to the strategic direction, was frankly no way to run a railroad. We got to the stage very early on in my tenure where we had a clear strategy. And from that strategy was devised an annual plan with a 3-year outlook. And I was judged and assessed on delivery of that plan. And I think that's the way to run a professional body, effectively, as a business. It can't keep changing direction every 12 months. Now, sure, when you bring presidents in who come from a variety of different backgrounds, and we had people from a very wide range of firms and industry and not-for-profit sector organisations, they all bring their own interests and strengths. But you can't change the oil tanker based on that.
I'm trying to get rid of the image now in my head of you as an oil tanker, but it's not you that's the oil tanker. It's the strategic plan that's the oil tanker, isn't it?
And the organisation.
That's been a lightning romp through 20 years in the audit and tax sector, but I know a lot of our listeners come from multiple sectors and from different countries all around the world. So I want to broaden our discussion out to focus on two issues that are going to be top of mind for a lot of people right now. So I'm going to ask you to engage in some crystal ball gazing, which is always risky, but I think you're more qualified than most people to have a valid opinion on these topics. I want us to talk about the impact of AI on professional work and also the impact of PE, of private equity's interest in professional work. So let's focus first of all on AI. I know that different firms are responding in different ways, but in a lot of professional firms and a lot of professional sectors, Gen AI is kind of sneaking in through the back route, through some of the younger people are trying it out and the more mature colleagues kind of tolerating it. Other firms are driving it more explicitly from the top. A broad question to you is, given your role as the body that was responsible for the training and development on the qualification of accountants, what are the implications for how students are trained? How do you see the nature of the professional training and qualifications changing over the next sort of 5 to 10 years to accommodate the implications of generative AI?
Well, the first thing, Laura, is I don't see it changing over the next 5 to 10 years. I think it's changing now. Historically, employers have taken in people usually from a graduate background, but not exclusively. And they have been given an ever increasing degree of responsibility during a training contract, which typically lasts for 3 years. And those tasks that they're given in years 1 and 2 are pretty formative, because they actually allow people to understand how a company works, how its processes work, follow those processes through the system, and reach a conclusion on the outputs of that, which allow an opinion to be expressed. It's those tasks which are most easily replaced by generative AI. I was on a panel a couple of weeks ago in the north of England, and we were fortunate enough to have a number of practitioners on that panel who had been talking about the way in which this was accelerating in their business. They said 6 months ago, they had no AI agents. But 3 months ago, they began rolling those out, and those had gone across the firm. This was a global firm. It was not just a UK adoption, it was an international adoption. And the particular use case that they chose to share is that if you're preparing, for example, a group set of accounts, and let's say there are 40 subsidiaries, somebody has to go through all of those subsidiaries and make sure that all the cross-references are the same, everything adds up to that group consolidation, and that would take somebody in year 1, year 2 of an accountancy training several days to do that work. The AI agent that has now been adopted by that firm takes 15 minutes. That work is no longer entry-level work. It's now work that requires an individual to oversee it and make sure that the outputs are as they would expect them to be. A massive change. The other thing which some of your listeners will remember is when they were trainees, they would perhaps take a sample of invoices or purchase ledger notes, and they trace them through the system. They might take 100 or 200 of those and follow them through. And if there were any exceptions, they'd follow up on those exceptions. Today, they are looking at the whole of the sales ledger. And that sales ledger is looking for anomalies, exceptions, unusual patterns. And if that produces 1,000 unusual things worthy of further investigation, they then do the work on those 1,000. But those are things that are out of the norm and could potentially help the auditor in their detection of fraud or other such anomalies in the system. I mean, it's completely changing audit. These tools are being developed most quickly in those firms which we would term the Big Four. As soon as you get outside of the Big Four, the investment is being taken forward at a different pace. So the immediate next tier, the BDOs, the Grant Thorntons, the RSMs, they have tools that they're bringing in, but not at the same pace. Then when you get past that group, and there are thousands of firms in that next group, they might be looking for external providers to bring forward their products and integrate those into their audit methodology. We're increasingly seeing a division brought about by technology.
Okay, so there's a lot you've said in that, and I want to unpack. You're talking about the removal of entry-level work, in a sense, or the digitalization of entry-level work. You're talking about effectively moving away from sampling to having Gen AI reviewing the full profile of financial information available. So both of those things together imply a higher level of audit scrutiny, but with no explanation of how you're going to train and develop people to get good enough to do that. It also has potential implications for the leverage model in these firms, the big four at least, hoover up hundreds of thousands of graduate entrants and then spit them out again pretty quickly year 1, 2, and 3 because they're not needed in that model.
For the benefit of society.
For the benefit of society. There's no judgment here. It's just a reflection of the economic reality. All right, so let's work at this backwards. If society has benefited from all these young auditors doing fairly mundane, routine, dull work, society will now lose these auditors because they will no longer be being trained up by these firms. Something really potentially fundamental is happening to the economic and organizational structure of these organizations, for the whole concept of how you become a professional in these organizations, and for how you engage with your clients. And all of these different elements are thrown into the mix by what you've been saying, which I think is really intriguing. So as a result, do you expect to see more or fewer audit scandals over the next 5 to 10 years?
I would expect to see fewer audit scandals because I think the quality of audit work now being done is better than it's been for decades, if not the best ever.
Partly because of the impact of AI in this area. Okay.
Yes. If you want to perpetrate a fraud, so let's look at a couple of big frauds that have happened in the past few years. So Wirecard, okay, international fraud, or Patisserie Valerie, a UK-based fraud. I mean, I think that both of those, in terms of dummy companies, false bank accounts being created, should be easier to detect if you have AI tools supporting the auditors looking at effectively every transaction through the company.
But only if you have auditors who are smart enough and astute enough to be able to understand the data that AI is generating. And bearing in mind they haven't been smart enough and astute enough to spot these errors before, now we're taking away the early rungs of the ladder in terms of the audit training. I'm curious that you are this confident that things are going to get better. How is one going to become a good accountant or good auditor in the next few years?
So if you think about training, the model whereby you have trained in situ effectively in the employer, well, it's definitely going to have to modify itself. But perhaps more of the training needs to be done within a classroom, a university type environment. And you actually bring people into the business who already have a high degree of understanding and proficiency about, for example, how things work. The UK profession has always had as one of its strengths that it brought people in from a very wide range of graduate backgrounds, and effectively through the training was able to get to a point 3 years in where in the examinations there was no discernible difference between the results achieved by an accountancy graduate and an economics graduate, or frankly a music graduate. I mean, that may have to be modified now, because I'm not sure that the employer model is going to be quite so flexible in terms of taking someone who on day one knows absolutely nothing about what they do.
I think this is really interesting. For some years now, when people have expressed concern to me about what's been going on in the audit sector and in the big four firms in particular, and I've often had a sense of an organisational and economic structure that is really creaking at the seams and is no longer quite holding it together. And that's why things go wrong, why surprises happen. And it strikes me that Gen AI has come along and represents a kind of key that can open up some of these kind of intractable problems that people have been trying to resolve by tinkering at the edges and making incremental changes. So I agree with you. I think the next few years are going to be phenomenally exciting in all sorts of ways that we haven't yet even fully anticipated or comprehended.
When we talk about training, we can have this conversation around the big four and their intake, but The ICAEW had 38,000 young people in training contracts when I left as chief executive. Half of that population are not in the big four, and they're in small and medium-sized practices. And those practices are not going to change anytime soon. And I think that they will continue to probably employ a more traditional model for another 5 to 10 years, maybe, because they just don't have the technology tools yet that are available to them. And if I went and visited one of those firms and talked to them about their business, I was often struck by the fact that it was still very much a paper-based office. And it didn't look much different to when I trained in the 1980s.
I think that leads on beautifully to the second core theme that I want to focus on here, which is the impact of private equity. You've talked about the need for investment in technology, the risks of lack of technology, and you're laying out there an apparent kind of bifurcation of the accounting sector. And private equity is potentially seen as a way of mitigating that disadvantage that the smaller firms are facing. One of our listeners sent me a question and said, could you ask Michael Izza, private equity firms always say nothing will change when they acquire a firm. Does he think that's true? And my reaction to that was, well, if nothing's going to change, why are they doing it in the first place? And why are the people being bought dumb enough to believe that that's actually going to happen? So looking at the impact of private equity potentially on accounting firms, what do you see the risks and rewards from the point of view of the partners who are selling out?
So let's start with the rewards first, because I think if you are in a firm of a certain size and you see the cost of doing business, particularly around regulation, technology, people increasing, and fees may be going up proportionately, but they may not be going up at the same rate, you're looking for something that allows you to transform your business. In 2007, the FRC did what I thought was a very important report called Competition and Choice, and they made 15 recommendations that they thought could improve quality in the UK profession and choice. One of those 15 was to be able to access new forms of capital, because if you are a partnership and you effectively pay out the majority of your cash profit generated to the partners, how do you grow, in some cases, the tens of millions of pounds needed to grow your business? All of a sudden, private equity allow firms to access capital that allow them to make this transformational change. And they do it in such a way that the partners find attractive because of the dividend that comes to them, but also because it allows them to effectively think about new things like technology investment, acquisitions. And let me just say, I think certainly in the UK market, but I think it's also true in the US, which has probably seen the most private equity recently injected into it. Scale is really, really important. So if you take the United States, there are 40,000 accountancy firms in the United States. 40,000. Now, it's a big country, but that's a lot of accountancy firms. If you take the UK is around 18,000 firms. That's too many. There's too many small businesses that, frankly, are going to have to change, consolidate. And private equity represents a lifeline to these people. And I think that it's too early to say whether or not it's going to be a change for the better. But you can already see with the investments that were made in originally Baldwin's and Blick Rothenberg, which have now become assets. I mean, you appear to have a large, stable firm that's doing very well and is sort of on the fringe of the top 10 largest now in the UK. That's a result.
What about the private equity firms from their point of view? I'm worried for the private equity people making a mess of things, not just making a mess of the firms that they're acquiring, but actually messing up themselves. And I know that a few have already spoken to me about concerns they've got and things that have gone wrong and things that they've been surprised by. What do you see from the private equity firm's perspective, the risks and rewards of piling in and filling their boots with audit firms?
If you're going to invest in a firm that has a significant audit component, it's a regulated industry. And I think that's something that the private equity investors are well aware of when they go in. This is a regulated sector, it's tight, and the regulators will intervene and have intervened, as we've seen in the last decade, with very substantial fines when they've needed to. The other thing I think is interesting, I'm not sure more quite how this dynamic is going to work, but when you're in a partnership, you have your partners, and the senior partners will often say that the most important stakeholder they've got will be your fellow partners who look to you to actually make sure that they can take their share of earnings drawings at the end of the year that they have become used to. You also have a regulator who's pretty important, but you're now introducing another stakeholder who is an equity holder in that firm. And you now have to manage this private equity investor. And that private equity investor will have their own needs and desires and wants. And I think that's going to take a new skill.
Watch this space, Michael.
But it is really interesting. It is really interesting.
I think I've become frustrated with the rather sort of breathless excitement and the magical thinking that really goes with a lot of the rhetoric around the impact of private equity. I think it can work, and I think it can be a lifeline for many firms, but it's not the magical solution, and it has to be worked through incredibly carefully. And you need a degree of patience and insight on both sides, which is far in excess of, frankly, what I have seen in the average firms. Some will do amazingly well and some will fail catastrophically.
Yeah, I agree with that completely, Laura. This is not a new experiment. So 20 years ago, there was significant interest in accountancy firms. And some of your UK listeners may remember names like Tenon and Vantis, who all took private equity or went to the main market, and they're no longer with us. So we do have to learn from their successes and failures and try and make a better job of it this time.
Having been in the role of CEO for almost 20 years, looking back to when you started, what do you wish you'd known 20 years ago that you know now?
The organisation 20 years ago had to change. And I wish that when a change moment had been required, I had been braver about doing it, because you spend a lot of time thinking about, well, this organisation has been around for over 100 years, people are going to be concerned about changes. But actually, when you make a change, and perhaps a significant change, you actually find that sensible people thought, yeah, why didn't we do that 10 years ago or 20 years ago? And instead of agonizing about, what reaction is this going to have, we've just got to get on and do it. Because very rarely does an action actually either break the business model or become sort of catastrophic for the membership. People adapt, get on with it, and the changes are usually for the better. So I certainly wish I'd known that 20 years ago. If you want an example, it was that tax. That tax issue still weighs very heavily on my mind, because people looking at what was going on knew that it didn't pass the smell test. And if something doesn't pass the smell test, you've got to have the courage of your convictions to do something about it. I'm actually really proud that the accountancy profession did that. We tried to get the lawyers to sign up to the same code, and they wouldn't do that. I think that says a lot about the difference between accountancy and law.
Michael, I'm just a little concerned that last comment will attract another wave of hate mail from all the lawyers who listen to this. I want to just round up with one other question to maintain the theme we've had of looking into the future. So looking forward, given all the challenges we've been talking about, what advice would you give to someone who's about to take on a leadership role in an accounting firm?
I would say don't put changes off until tomorrow, because you could find that if you wait too long, your business disappears. So don't put off the changes until tomorrow. Do them today.
That's a brilliant note to end on. Michael, thank you so much.
Thank you.
3 themes came through strongly in our discussion that are important for all professionals, not just accountants. The first is how Gen AI fundamentally challenges the way that professional services firms make money. Clients pay substantial fees for inexperienced juniors to do fairly routine work, because juniors' time is cheaper than the senior professionals they work with. Seniors understand they have a responsibility to train juniors, and in return they enjoy the profit of their juniors' labour. Meanwhile, juniors go along with this because they're receiving a valuable training and have a chance of becoming seniors one day and profiting from the juniors below them. This is how the leverage model has always worked. But Gen AI challenges this. As a result of Gen AI, the largest professional service firms are set to shrink in scale without any commensurate increase in profitability. They'll no longer need to recruit vast numbers of junior professionals, and clients may be reluctant to pay premium fees for AI-generated work. So they'll need to find new ways to generate sustained growth and profitability. The second key theme is increasing bifurcation. Smaller firms will struggle to sustain investment in AI and will fall further behind the larger firms. But another kind of bifurcation will occur between the winners and the losers. Large-scale investment in technology is notoriously risky, and with technology developing at such a pace, there'll inevitably be mistakes and missteps. Some bigger firms will fail badly, and some smaller firms will be surprise winners. But if previous trends are anything to go by, all firms will move forward in the confident expectation that they'll be one of the winners. The third key theme is the impact of private equity on the governance of professional service firms. The partnership model is not an anachronistic relic of a previous era. For all its frustrations and limitations, it survived and adapted because it's uniquely well suited to the governance of professionals. A partnership, big or small, is a complex ecosystem. As so many failed mergers have demonstrated, it's also particularly fragile and easily destroyed. A while back, I was approached by the CEO of a professional firm whose partners had sold to a private equity firm a few years previously. The PE investors saw enormous unexploited potential and were keen to help the firm's partners achieve it. But the partners didn't understand the scale of change this would entail, and the CEO was stuck in the middle. He asked me to help him find the optimal way of delivering on the ambitious growth targets for the PE owners without triggering wholesale rebellion amongst his colleagues. I spent time interviewing his colleagues in depth and analysing the complex dynamics amongst them and their businesses, and I identified the root cause of the problem and proposed a set of solutions. But when I finally met the owners of the PE firm, I understood how significantly they'd misjudged the business they'd bought. They saw only its extraordinary potential and had assumed the partners would share their enthusiasm for exploiting it. But the partners had a much more nuanced mix of motivations than pure profits growth. And this brought home to me the vast gulf between the complex reality of most partnerships and the simplistic assumptions embedded in private equity valuation models. My experience of living through boom and bust in my early 20s made a big impression on me. It left me with a profound curiosity about this mysterious thing called partnership, whose true value only becomes apparent to its owners after they've sold it. It taught me to be very cautious about the waves of hype and hysteria which periodically sweep through the financial and professional services sector, and it taught me that once the hype and hysteria have faded away, fundamental change remains. That change always takes longer than the enthusiasts predict, but when it happens, it's profound and long-lasting. By the end of the 1980s, the government brokers no longer wore their silk top hats, and the City of London had changed forever. So thanks for listening, and thank you again to Michael Izza CBE for joining me today. In the next episode, I'll be interviewing Paul Lewis, managing partner of global law firm Linklaters, on the theme of becoming professional. We'll be talking candidly about how you learn to look, sound, act, and even feel like a professional. In the meantime, you can read much more about leading professionals on my website, lauraempson.com, and please remember to subscribe, rate, and review Leading Professionals wherever you get your podcasts. Be sure to join me next time.